Ladies and gentlemen, today, we are here to discuss a critical aspect of our nation's economic stability, the foreign exchange reserves of India. These reserves, comprising foreign currencies, gold, and special drawing rights, SDRs, held by the Reserve Bank of India, serve as a financial safety net and a powerful tool for economic stability. India's forex reserves have grown substantially over the years, making it one of the largest reserves globally. As of the latest data, the reserves stand at over $590 billion. This remarkable accumulation of reserves is not just a number, it is a reflection of our economic resilience and a strategic buffer against unforeseen external shocks. The importance of foreign exchange reserves cannot be understated. Let us delve deeper into the composition of these reserves and their implications for our economy. India's forex reserves comprise four key components: foreign currency assets, gold reserves, SDRs, and the reserve tranche position, RTP, in the International Monetary Fund, IMF. Foreign currency assets constitute the largest share of our reserves and include US dollars, euros, pounds sterling, Japanese yen, and other currencies. These assets are held in the form of government bonds, treasury bills, and other safe instruments, ensuring liquidity and stability. Gold reserves, on the other hand, serve as a hedge against inflation and currency depreciation. The SDRs are international reserve assets created by the IMF and represent a basket of major currencies. Lastly, the RTP reflects India's portion of IMF resources that can be readily accessed for economic stabilization. Why do we accumulate these reserves? The rationale is multifaceted. Firstly, they act as a shield against global financial instability, protecting the Indian rupee from excessive volatility. During periods of economic crisis, such as the Asian financial crisis of 1997 or the global financial crisis of 2008, countries with ample reserves were better positioned to withstand external shocks and avoid a balance of payments crisis. Secondly, reserves enhance investor confidence. A robust reserve position signals a country's ability to meet its international obligations and service its external debt. This, in turn, fosters investor confidence, attracting foreign direct investment and boosting capital inflows. Foreign investors closely monitor a country's reserve position, and a healthy reserve balance is often interpreted as a sign of economic stability. Moreover, forex reserves facilitate crucial imports, especially during times of global disruptions. India is a significant importer of crude oil, electronic goods, and pharmaceuticals. Ensuring that we have sufficient reserves to cover essential imports for several months provides a buffer against supply chain disruptions, currency fluctuations, and global trade uncertainties. Additionally, the reserves also serve as a tool for currency management. By buying or selling foreign currencies, the Reserve Bank of India can influence the exchange rate of the rupee, ensuring stability and preventing excessive volatility. This is particularly important for a country like India, where the exchange rate can significantly impact inflation, trade balances, and external debt servicing. However, maintaining substantial reserves also comes with certain costs. The opportunity cost of holding these reserves includes the potential returns that could have been generated through productive investments. Instead of holding assets in foreign currencies, which typically yield lower returns, the government could potentially deploy these funds in infrastructure development, education, or healthcare. Therefore, the challenge lies in striking a balance between reserve accumulation and productive deployment. Economists often debate the optimal level of reserves, considering factors such as import cover, short-term debt obligations, and exchange rate stability. India's reserve adequacy is assessed through metrics such as the import cover ratio, which measures the number of months of imports that can be financed with current reserves, and the external debt-to-reserve ratio, which assesses a country's ability to meet its debt obligations. In recent years, India has also explored ways to enhance the returns on its reserves. The RBI invests a portion of the reserves in relatively low-risk, high-quality financial instruments. Additionally, the central bank engages in currency swaps and other financial transactions to optimize returns without compromising safety and liquidity. Looking ahead, the role of Forex reserves is likely to become even more significant amid global economic uncertainties. Geopolitical tensions, volatile energy prices, and shifting trade dynamics can all pose risks to India's economic stability. In such a scenario, maintaining adequate reserves will be crucial for safeguarding our economic sovereignty and ensuring financial stability. In conclusion, the Forex reserves of India are more than just a stockpile of foreign currencies, they are a testament to our economic prudence and strategic foresight. They serve as a buffer against external shocks, a source of investor confidence, and a tool for currency management. However, it is equally important to ensure that these reserves are managed efficiently, balancing liquidity, safety, and returns. By doing so, we can navigate global economic uncertainties and secure a prosperous future for our nation. Thank you.